Good morning and welcome back to Almus Market Mornings. While the letter by the Iranian president makes headlines where he calls for the Americans to look past the rhetorics, the RBI's circular has been creating the rhetoric back home. So initially, RBI came out with a circular to cap arbitrage positions for banks between the onshore market and the offshore market, but the most recent circular even prohibits banks from offering positions in the NDF market to corporates. The moves on Monday were wild. Rupee was initially stronger at 93.5, but then weakened past 95. This additional circular, where it is being prohibited to being offered to corporates, will create a bit more juice for the rupee to appreciate. But let's understand this from JK. Good morning, JK. What do you think of this new circular, and how do you see it impacting the rupee?
Good morning, Swaraj. I have seen some regulations, directives from RBIs in the past cycles of rupee weakness, but nothing like the wave of regulations that I have seen in the last 2 3 days, and it really shows the extent of importance that authorities have attached to the kind of moves and the one-way weakness that we have seen in the rupee over the past several months, and that has intensified. Of course, the war was a new factor, and oil price going above 100 is definitely big negative for the rupee. But while these, fundamentals cannot be altered by us, what RBI is trying to do is at least to remove the excess demand from the market, or which is also, part of it led by speculation, so that the pressure on the rupee is eased to some extent, at least, if not completely removed. So definitely yesterday's moves by RBI has shown that they are intensifying the crackdown on speculative activity. On Monday, we had shared what they had done towards the banks running their net open position on the onshore market, well in excess of 100 million, which is prescribed by RBI. But this was being done by banks by netting their offshore oversold position. So they were still within the limit if you combine both the limits. But now RBI said that only the onshore limit, irrespective of any other position, should be below 100, and this led to the expectation that banks will be unwinding. And despite this fact, we had seen the rupee fall to a new low on Monday to 95.20. Of course, it was in the late trades, but this move was a bit surprising. But it transpires that one, there was a month-end demand or year-end demand, you could say, which kept the rupee higher or the dollar rupee higher. But more than that, it appears that while the banks have been prevented from creating their own position in the offshore market, the freedom for corporates to get hedges in the offshore market through the banks was still available, and a huge volume has happened on that day, as per some reports, through which corporates would have bought dollars here and taken their export hedges offshore, which means the pressure on the rupee for weakening once again came back into play on Monday. And perhaps realizing the this gap, RBI has introduced the new measures yesterday, through which the banks are barred from giving any hedges to the corporates through the non-deliverable forward market. And so the clients will have to take their hedges only through the onshore market. And the other regulation that came yesterday has actually barred the banks from rebooking any foreign exchange derivative contract on behalf of clients, whether it is deliverable or non-deliverable, what the contract which are cancelled from April 1 onwards. So these, which means, the corporates who want to book a forward contract to hedge their dollar exposure will have to, either take delivery or cancel and be exposed to the market moves subsequently. Earlier, the facility of the dynamic hedging through which corporates could cancel and once again rebook when the rates came in their favor. That facility is completely removed. Now what this was doing was that against exposure, if a corporate was booking an X amount and cancelled it, and if they rebook it once again, which means there is multiple purchases that is happening against the same exposure, and that kind of buying pressure is now probably not going to be there. Only question that remains unanswered and perhaps requires clarification is whether the rollover, if the exposure is extended, or if the original contract is booked for a date prior to the expiry or the delivery due date is needs to be cancelled, whether that can be rolled over or not. That is something that will get clarification. So my view is that while these measures can work in the short term due to the position unwinding by banks, technical result or in a technical factor working in favor of the rupee, and perhaps removing excess demand from corporates by removing the facility of dynamic hedging, I'm not sure that fundamentals of higher current account deficit driven by higher trade deficit, lack of capital flows, and higher inflation due to the oil will prevent rupee from falling further. Eventually, we could have some relief, perhaps by April 10th. Because that is a new deadline. That is a deadline given to banks to unwind their excess position unless it is extended further. But once these positions are unwound, I think we are not going to see, the rupee on based on fundamentals rally once again. So I think this is a matter of short-term relief for the market unless the global situation eases further. But there are no signs that the global position is easing further. In fact, we had the address by Trump today, which was much looked up to by the markets, but there was nothing new in his statements. He was saying that they would finish the war, very soon. But what the most important thing that he mentioned was US does not require Hormuz Strait, which means possibly they are not going to insist on Hormuz Strait opening up as a precondition for ceasefire. So it will be up to Iran to decide whether they will open up the strait for other countries who are not in war with them, and if they continue to hold on to that, which they might, because if they do that, oil prices in US will also be on the higher side, even if they don't depend on supplies through the Hormuz Strait. However, there are possibilities that if the oil price stays high, US might well resort to fiscal support to their customers or to their consumers by subsidizing the oil prices. So it's a whole lot of possibilities going forward. But in any case, unless this aspect is removed and unless there is clear signs of de-escalation in the war, I think there is no sustainable relief for the markets, and that is important for the rupee as well. As far as the other markets are concerned, we had 2 days of relief rally after indications from one Iranian officials they would be ready for talks if there are guarantees of no further attacks. However, this was not confirmed by other reports which were still continued to say that there were attacks going on from both sides. I would say that the ceasefire aspect is still not very clear. Market now probably believes that either US will uh, achieve a ceasefire eventually, or if they don't, then they will intensify the attack and perhaps try to win the war. So these are the possibilities on which the markets had hoped and rallied, but that is now actually put into doubts as well. So we had gains in the US markets by 3 to 5% over the last two sessions. Gold had rallied almost to 4,800. Just a couple of days back, we had seen 4,400. even the yields had come off on the assumption that oil prices would ease off. Oil prices had come down from almost 120 on early Monday to 99 that was seen today. But again, after Trump's speech, disappointment from by the market, that was nothing concrete about a ceasefire or the war ending, led to these gains being reversed. And of course, because of the local regulations, which is now driving the rupee more than anything else, at least for the short term, rupee seems to be on the stronger side, even below 93. Let me reiterate that this is mainly due to the RBI regulations, and this could play out for some more time until the demand side picks up much more and absorbs the selling by the banks. I think it's very difficult to say whether we'll break down even below 92. 92 seems to be a very strong level for the rupee. In the meantime, bit on the economy, US economy, yesterday at least we had some good data. ADP job creation was 60,000 versus 40,000 expected. Consumer confidence also edged up. However, while that number is higher, the inflation expectations has surged. Inflation expectation has also surged in Europe. So this is a new, aspect that is coming up in almost all the economies. Growth perhaps will take a hit as oil price stays higher, and the inflation expectation going to be even higher, and therefore we see a stagflation situation which will be faced by most of the economies. So while the war on the one side remains unresolved, and these problems have slowly started to creep up in the major economies, so don't see a sustainable relief for the markets. Whatever we have seen in the past years should be treated as a relief rally unless we see very clear ceasefire talks that go on between the countries involved in the war. Thank you.
Thank you, Jack. And yep, the theme for the past 2 days have seemed to be the relief rally generally on the expectation that the wars will ease up, but it doesn't look like so. Even the address by President Trump did not seem to excite the markets. The continuous rhetoric of America ending the war in 1 2 weeks has prevailed, but it as of now it's not exciting the markets to that extent. Moving on to the domestic markets, of course, there's a whole host of new regulations, and much interpretations are left to be derived from these regulations. But in the short term, due to the unwinding of these arbitrage positions, there may be a rupee appreciation bias. But do remember, folks, the underlying fundamental is unchanged. We are still facing higher oil prices and lack of capital flows. So, as soon as markets find their base to purchase dollars, we might see another round of move higher. That's it from us today. Thanks for listening. We will catch up on Monday with a fresh round of updates as markets are closed for Good Friday tomorrow.